What if I told you there's actually a way to time the market? I know what you're thinking. Time in the market beats timing the market, and you'd be right if we were still playing by the old rules. But the game has changed. If you use the old strategies, you're going to get left in the dust. DCA or dollar cost averaging is no longer the king. Lump sum investing can't beat it, and it works in almost any market you can think of. Most investors never consider the underlying heartbeat of the economy and how tapping into its rhythm can lead you to near guaranteed success if you stay consistent. Combining these two strategies will catapult your gains, allowing you to beat the market consistently. Make sure you watch until the end to find out exactly how to execute the strategy and multiply your long-term gains. But here's the problem. A weakness that came up in all of these studies and the single pitfall of this method that I'll show you how to avoid. Don't miss it because it could cost you your future wealth. So you might be wondering what could possibly beat the current champions of investment strategy, the two strategies that most people today, whether you're investing crypto, stocks, or any other asset class, use, and that is dollar cost averaging and lump sum investing. Let me know down in the comments below which one of these you use, or if you have a completely different strategy altogether. I prefer lump sum investing when markets are heavily red, and I don't see much point in buying into all-time highs, which you would do if you were DCAing. But these are two entirely different strategies for that exact reason. One relies on constantly investing in the market, averaging out slightly below market return, and the other is a bit riskier and has the potential to gain more or less depending on how good your research and intuition is, with a dash of luck, of course. But what if I told you there's a better way? A way to stay in the market so you don't miss potential rallies while also allowing you to avoid crashes and declines like the one we're living through right now. Believe it or not, this isn't a new concept. There have been a lot of people throughout history trying to find the holy grail of investing, timing the market. But here's the thing. It might already exist. An accurately named AQR paper, Market Timing, Sin a Little, trialed a new strategy by fire. What they found was incredible. They actually went through the last 116 years of the stock market returns, even going as far as scraping around dusty old libraries for hints at valuations before the main ledger was set up. It's pretty impressive, but what's more impressive is how valuable the data is that they uncovered. They found there was a link between weighting your investment based on the derived expense of the market compared to the past valuations. But that's not all. With this data at hand, they did the mother of deep dives on statistical analysis. They created models which weighted stock prices as cheap or expensive based on 25-year data groups. To put it simply, if stocks were valued higher in the past, based on the 25-year average, they would rate the current prices as cheap and increase investment levels. If, however, they were more expensive now, they would reduce investment. Now, the way they worked this out was actually pretty complicated, so I'm going to sum it up for you quickly. If a company was worth $1 million 20 years ago and made, let's say, $200,000 profit a year, you have a price to earnings ratio of 5 to 1. Pretty simple, right? Now, if that same company is worth 50 million today, but makes 5 million in profits, that's now a P to E ratio of 10. Another way to look at it is if you bought the asset, how many years would it take for you to make your investment back? I'm sure you'd be much more interested in buying an asset that gives you your investment back in 2 years rather than 50, right? The longer it takes, the more expensive it is. In my example, the asset is now twice as expensive to buy per dollar compared to 20 years ago. Now that's just the basics, and the actual formula is a lot more complicated than that, but we'll keep it simple. If you're a member of my private newsletter, you might have heard me mention countless times whether Ethereum or Bitcoin is currently cheap or expensive, and if it's a good time to buy. This is the strategy that I'm referencing. Let's take a look at how they use this research. What they essentially did is crack the formula for measuring how overpriced or underpriced today's valuations are compared to the past. With this single formula, they tested it on overall indexes and individual companies, and what they discovered was incredible. In their tests, they managed to exceed, if only slightly, the market average return over the period of 1900 to 1958. This may be small, but it was statistically significant, and returns were even greater when investing based on sector rather than the broad index. By using a 60-year average window for their multiplier, they found their returns to be lower, but still significant. The evidence for higher valuations predicting lower subsequent returns and vice versa does indeed appear strong. This quote from the paper highlights just how monumental this was. But there was a problem, and I think the source of this problem is exactly where this updated strategy excels and why it's so effective compared to every other investment strategy out there. They found returns averaged slightly lower than the market in the 1958 to 2015 period, which sounds odd because didn't they mention returns were statistically higher? Well, it depends on how many years their average shifted, and they found stocks not only become more expensive over time, but have also remained more expensive as their baseline. So their formula was actually underinvesting from 1958 to 2015, and it ends up being slightly beaten by traditional buy and hold. Clearly, other factors are at play here, and this study is only half of the story. The key takeaway is that by scaling your investments and alternating between overpriced and underpriced sectors, you can beat the market year after year. So what did they miss, and why is it so crucial to the new formula for success? They didn't just miss one element, they actually missed 3, and each of them is equally important to unlocking the true potential of this strategy. The first one is simple, and they even addressed it in their paper briefly, and that's how external market factors such as overall interest rates affected the long-term valuations of companies. This is the cause of their underinvestment, especially towards the end of the 20th century. As rates dropped from 20% to 1%, the S&P saw a 10-fold increase in value. These rates have remained between 0 and 5% since then, as stock and asset values have climbed even higher. However, just as recently as last month, that trend has been broken, and here's the second factor. All markets are cyclical. This forward statement is probably the most widely known yet ironically overlooked factor when it comes to investing. Everyone knows the stock market alternates between rallies and crashes, with recessions every 10 years or so, with property typically having an 18-year cycle. But what exactly causes these patterns, and can they really be predicted? Now, there's no smoke and mirrors to this. Whether you're investing in the S&P 500, real estate, or even Pokemon cards, there will be periods of high demand and euphoria, matched by equally low demand and, of course, despair. We've all been there, and the crypto bull run is still fresh in our memories, and in hindsight, for some people, quite painful. From 2020 to 2021, Bitcoin had a spectacular rise from under $4,000 to almost $70,000. You had new projects releasing every other day, sometimes multiple times a day. If you weren't getting a 10x, then what were you even doing, right? It was euphoric, and that's the entire point. Innovation, euphoria, greed, natural human emotions which result in risk-taking, over-optimism, and claims of, if you get out now, you'll miss the real gains. People simply couldn't imagine crypto going back down. Before the bull run, there were people saying Bitcoin would never break 20k, yet it did. It broke through every price barrier and exceeded everyone's expectations, and so did Ethereum and countless other projects, and people were saying that until the very top. I knew people who remortgaged their homes to throw it all into Bitcoin at 60k. But here's the point. This has all happened before. Back in 2017, Bitcoin broke through $1,000 and shot all the way up to 20k. There were people saying it would never double to 2k, it would never break $4,000, $5,000, $10,000. All of them were wrong. But even the people who bought right at the top, the people who held on for 3 difficult years of crypto winter, they still tripled their money in the end. They just waited for the next cycle, and it'll happen again and again and again. As long as real people with real emotions are investing their money that they value and speculate with, there will be cycles of euphoria and despair, highs and lows, profit and loss. Now, if you really think about this and step back, don't get caught in the hype, don't get stuck in the despair, there will be another bull run, and after that, there'll be another crash. So hear me out. When you see a chart that looks like this, there's a good chance you're soon going to see a chart like this. Maybe not reaching as low as before or as long, but the thing is, if everyone you know is getting rich in something and telling you to buy and are showing you a chart that looks like that, then it's not going to last much longer. Sure, pulling out early might lead to some missed gains, but as I've said countless times on this channel, your absolute #1 priority should be protecting your capital. Yes, of course, more capital is better, but protecting what you have should be of utmost importance. People in the 1850s didn't have the internet. What if I told you people in the 2020s don't have augmented reality yet? They don't even have personal AI, which invests their money for them while they sleep. And here's where it gets a little hazy. Actually predicting future technology is just like predicting what the S&P 500 will be on the 23rd of August in 2074. It's impossible, but I think we can all agree that technology will be more advanced at that point, and the S&P, Bitcoin and Ethereum will likely be higher than they are right now. Well, here's where you've got to do your own research, but I've already done a bit of my own based on the current tech focus around the world and where investment is going globally. Here's my speculative insight on future tech cycles. The easiest way to estimate the markets of the future is to see what's trending today and how much investment is going into it, whether it's working or not. While computer power hasn't quite kept up with Moore's law in recent years, we're still making impressive leaps forward in data processing every year. cheaper. And alongside that comes an ever more realistic ballpark for augmented reality and AI to flourish. When you have massive companies like Meta, Tesla, and Nvidia throwing billions into AI and augmented reality, you know it's just a matter of time before these investments start paying off. Blockchain tech is right alongside them and is one of the fastest growing innovations of the last decade, and has already created several different industries and is set to even create more in the near future. This all combines into increased automation and eventually, though a little further out, space-based industries utilizing the new automated robotics and AI that will develop in the coming decades. Now, these assumed innovations aren't actually the focus here. It's the implication, and that implication points to an ever greater scaling in business and margins as outdated manual labor practices are replaced and computing becomes much more ingrained into our lives. This means higher valuations, more participation in global investments, and much more energy usage as the world grows wealthier. These benefits will come with their own set of problems, and that's where predictions get really tricky. Just to hammer this point home, we can easily see where investment went as previous cycles passed. Innovators in the dot-com boom leading to the rise of search engines and the internet, the switch from brick and mortar retail to online shopping, the growth and domination of social media and tech giants serving ads to those online markets, the transition to electric vehicles and green energy investment, and finally the crypto and blockchain boom. As long as you know the general trajectory of technology and what's on the horizon, you can ensure you aren't underestimating potential growth in worldwide markets, a mistake that the research paper at the beginning of this video made. Long-term cyclic interest rates and fiscal policy, understanding how this impacts market sentiment and emotional investment to cause booms and busts, and lastly, keeping track of emerging trends of technology and how it'll change the future landscape of business. These are your three factors. Now I'm going to show you how to combine them with a formula to truly beat the market. The timing strategy applies a weight of 100% plus trimmed Shiller EP minus median Shiller EP all over 95th minus 5th percentile range, with a floor at 50% and a cap at 150%. The trimming at the 95th and 5th percentiles helps reduce the distorting or compressing effects of extreme values. This is the formula, the final form of dollar cost averaging and lump sum investing infused into one. But this is just the baseline. Don't make the mistake of running with this formula by itself, or you're going to get caught out by the long-term trends just like the study did. We're smarter than that. We're going to use this baseline, but add an additional set of modifiers to it, though these will be subjective based on your own research and beliefs. I call this approach weighted cyclic averaging, and I'll show you my personal opinion on modifiers, but this is not financial advice. First, the issue of interest rates. These are a big factor and work inversely to valuations. Rates go up, stocks go down, and this is exactly how we're going to modify it, except we will adjust it based on the likelihood of rate rises in the next 5 years. And right now, I'd say that's pretty high, coming from all-time lows. So that's our first modifier. Simply multiply the previous formula by 50 to 150% based off the direction you estimate rates will average out. Higher rates being a lower multiple. Now for the second. That will depend entirely on what market you're targeting. This is going to get a bit complicated, so make sure you follow along closely or rewatch this section until you have a good idea of each step. Every cycle is different, and not every cycle is the same length either. I'd personally modify this one on a much smaller timescale. Take the average length of a full cycle, 3, 6, 10, 18, whatever it is you choose. Measure from the previous peak and set out a range into the future. The closer you get to the next inversion of the cycle, the lower your modifier should go, until at the expected peak, you're barely investing anything. However, if your other two multiples are working correctly, even if this multiple is low, you should still be investing enough if the other factors are positive for further growth. But I'd like to be particularly cautious at this point. This one is of course 50 to 150%, with the closer you get to the next peak, the lower the multiple. Lastly, and by far the most difficult modifier to work out, will be your tech weight. Again, this will vary massively between your chosen markets and should have the least weight overall. Though if you're investing in the oil sector and you start noticing more stories about alternative fuel investment picking up, it might be time to raise that weight a bit and start to scale back. This one is more of a guide, and to be honest, I can't really think of any other way to define it by a number, so let's just put this down as 1 or 0, where it either doesn't affect your investment or it significantly reduces it based on your perceived future risk. Now that you have the final formula, how exactly do you apply capital with it? Do you DCA this multiple, or do you lump sum invest? What if you run out of money to invest? Finding your capital pool is really down to your preferences. Is your pool deep? Maybe it's shallow, is it fast flowing with lots of personal income, or is it steadily filling up with a trickle? Whatever your capital availability and your appetite, finding out your allocation is pretty important, as you want to be able to keep your capital flowing evenly. You want to avoid having too much, or worse, too little cash at hand when the indicators are turning in your favor. Because this is a long-term investing strategy, you need to simply work out your available cash flow for investment and just apply the formula. This can suit both DCA and lump sum investors, as it doesn't matter when or how often you invest, as long as you invest at least once per year when the indicators are looking best to maximize your returns. If you have 10K to invest and your multiplier is 70%, you can put in $7,000. Keep in mind this can apply for different sectors and can also be used to rebalance portfolios, meaning you can still invest the full 10K as long as you correctly apply the weighted index. The obvious benefit of the strategy is by setting up a system which reacts dynamically to the market average. You're preventing yourself from over-investing when prices are clearly too high, and helping you invest more during great buying opportunities. While this strategy is effective, it's not flawless, and the market does have its ways of surprising us. The true top and bottom can never be predicted accurately, and as accurate as this can be at telling you when a market is overbought or oversold, there's no way to tell how high or low it can really go. You'll run out of money to invest eventually. Plowing more cash each month into an extended bear market will inevitably lead to your reserves drying up. There's no worse feeling than seeing the bottom get hit and sitting there without any way to capitalize on it. The opposite can also happen, where you see the market pushing higher and higher as you pull back on investment, and this could potentially last for years. I completely understand the feeling of missing gains and what ifs of investing more as the market rises, but that's an inevitable bull trap. Eventually. The key is, if you stick to the strategy, you'll have years worth of strong investment, especially when the markets have been down in the past. These past investments will be skyrocketing if the market is rising fast enough for you to start regretting not having invested. A year or so of reduced investment is a price worth paying for it all to evaporate when the market changes direction. Then you'd wish you didn't invest on that exponential rally, of course. Hindsight is always 20/20. Even so, the current bear market we're experiencing might not even have happened, or could end tomorrow, or maybe continue to new highs in a few months. Nobody really knows. What we do know is that despite the huge drops, current valuations are still insanely high compared to historical levels, with interest rates going up soon, making the probability of further declines quite high. The most important thing to remember is whichever strategy you use, whether it's weekly cost averaging, DCA, lump sum investing, or something else entirely, as long as you're consistent and long-term focused, it'll eventually pay off. If you made it all the way to the end of this video, please let me know what your investment strategy is down in the comments below.